Investing is subject to risk, including possible loss of principal. Be aware that fluctuations in the financial markets and other factors may cause declines in the value of your account. There is no guarantee that any particular asset allocation or mix of funds will meet your investment objectives or provide you with a given level of income. Investments in bonds are subject to interest rate, credit, and inflation risk. Investments in stocks or bonds issued by non-U.S. companies are subject to risks, including country, regional risk, and currency risk. These risks are especially high in emerging markets. The opinions expressed here are, as of the date of this recording, are subject to change in the future. Tranquilli Financial Advisor, LLC, Beacon Capital Management, and Vanguard Investments may change their investment thoughts at any time in the future. Important, the projections and other information generated by the Vanguard Capital Markets model regarding the likelihood of various investment outcomes are hypothetical in nature, lost my spot letting folks in, do not reflect actual investment results and are not guarantees of future results. Vanguard money management results will vary with each use over time. The VCMM projections are based on statistical analysis of historical data. Future returns may behave differently from the historical patterns captured in the VCMM. More important, the VCMM may be underestimating extreme negative scenarios observed in the historical period on which the model estimation is based. The Vanguard Capital Markets model is a proprietary financial simulation tool developed and maintained by Vanguard's primary investment research and advice teams. The model forecasts distributions of future returns for a wide array of broad asset classes. Those asset classes include U.S. and international equity markets, several maturities of the U.S. Treasury and corporate fixed income markets, international fixed income markets, U.S. money markets, commodities, and certain alternative investment strategies. The theoretical and empirical foundation of the Vancard Capital Markets model is that the returns of various asset classes reflect the compensation investors require for bearing different types of systemic risk beta. At the core of the model are estimates of the dynamic statistical relationship between risk factors and asset returns, obtained from statistical analysis based on available monthly financial and economic data from as early as 1960. Using a system of estimated equations, the models then apply a Monte Carlo simulation method as well as uncertain randomness over time. The model generates a large set of simulated outcomes for each asset class over several time horizons. Results produced by the total will vary with each use over time. And I do understand that there is a typo at the end there, and I will fix that as part of our work after the video conference is over. I'm going to stop my screen share there and welcome everybody in. Thank you again for being here. Again, Chris Cook of Beacon Capital Management, Matthew Nadler, thank you both. I appreciate your time and being a part of the conversation. Matthew, if I can ask you right away to introduce yourself to everyone in greater detail, if you will, than I had already provided.
Of course. Thank you, Lou, and thank you again for having me on today. Good morning, everyone. Matthew Nadler here from Vanguard. So I work in our financial advisor services division, working with sophisticated financial intermediaries such as Chris, also on this call today, really helping them in their business with any Vanguard products and services they may desire. I'm an analyst on the team, so I enjoy diving a little bit more into the investments, and that's why I'm here today. Talk a little bit about what Vanguard's thoughts are across a range of topics that Lou, Chris, and I have discussed ahead of time.
Excellent. And Chris, please, one more time, introduce yourself to everyone listening, and of course, those that will watch after when we send out the recording.
Sure. Hi, everyone. My name is Chris Cook, founder and president of Beacon Capital Management. I develop the strategies that most of you are using that are Beacon clients. So I'll share my thoughts on those, along with Matt and Lou.
All right. Well, thank you both. Now, all of that process that we have to go through took about 6 minutes to get done. So I would like to jump right in because with about 40 minutes or so to go, we have a lot to talk about, and we're really glad to have Matthew here from Vanguard to comment on it. Matthew, we started with our conversation and preparing a broad market overview. What brought us to this place that we're in right now where almost daily, maybe not the last few days, but almost daily, we're talking about record highs. What brought us to this level?
Absolutely. I think, Lou, this conversation would almost be remiss without starting with a little bit of context setting. So when Vanguard was looking at 2021, what our expectations were for this year, we were pretty vocal in calling out that health outcomes were going to be the main driver in our view of economic outcomes, right? So the efficacy of that vaccine rollout effort, how quickly we were able to get shots distributed both in the US and internationally, that would determine how quickly economies could return to some kind of normal in terms of that economic activity. And so we've kept a close eye on really that rate of vaccination across the world. And earlier in the year with the US specifically, we actually had some projections, our kind of base case, suggesting that we'd hit some sort of herd immunity to the extent that's attainable by mid to late summer, right? Depending if we could keep that pace up. And so in line with that projection, we were looking at the second half of 2021 as being a time really denoted by a big pickup in economic activity. Again, as we return to some sort of normal, whatever that new normal might look like. So where we stand today, sitting here before you, we are seeing growth starting to pick back up in the US as that vaccine rollout continues, and certainly optimism over some sort of end potentially being in sight. In contrast, we have seen some developed economies internationally, maybe seen those efforts falter to some extent. The Eurozone, for example, having to have certain countries reintroduce some form of lockdown at times. And of course, I'd be remiss if I didn't mention stimulus, right? So we expected some sort of stimulus as we saw at the end of 2020. I think the package passed earlier this year, that $1.9 trillion American Rescue Plan, that was actually beyond our economists' expectations. And as a result, when we laid out our economic and market outlook for 2021, we were projecting about 5% growth in US GDP as the recovery from the COVID-19 pandemic continued. We actually adjusted that growth rate upwards pretty notably, up 2 to 2.5%. So we're now looking at a growth rate of about 7 to 7.5% for the United States GDP for this year, some of the highest we've seen maybe since the early 80s. Last thing I'll note on the economy front is we did recently see some numbers that came in below estimates from a jobs perspective with that April jobs report. We are viewing this as more of a bump in the road rather than any sort of broader sign of a derailment of the recovery or anything like that. In our view, we believe employers are extending hours, offering more pay in response to the demand they are seeing, perhaps waiting for more sustained evidence that demand is back before looking to add when we're thinking about non-farm payrolls. So nothing changing from our forecasts there. So how that's translated on the investments front, certainly with Q1, again, COVID optimism, improving vaccination rates in the developed world, very much the theme, seeing big inflows into equity funds. And then of course, the surge of liquidity we saw with stimulus checks, the drawdown of the Treasury General Account. We're seeing a lot of flows into risk assets as a result. And very interesting trends that were reversals of what we'd seen perhaps in 2020, seeing some of the more industrial manufacturing heavy areas of the market doing better than tech for the quarter at the beginning of the year, and actually seeing some select European markets outperforming US markets, again, a reversal of 2020. And lastly, of course, that rotation into more value-oriented stocks accelerating as well. So a lot of things we're keeping our eye on, but very, very interesting, exciting start to the year.
Well, and that's a lot to unpack, and I'm not going to unpack it all. We'd be here instead of 40 minutes, 4 hours. So we'll start with the GDP, a definition, please, because we have a rule here, and Chris knows it well, Matt, and we're going to bring you in on it. We don't speak financial advisor here. We want GDP. So gross domestic product, growth of, let's call it 7% or more in your estimates. Why is that such a positive impact on the current market? And we'll get into what the environment of the current market looks like in just a moment. So why does that have such an important impact on the stock market?
Sure. It's important because that's what you use as a barometer for just aggregate economic activity within the US. Right, so when you're thinking about an economy, how well it's functioning and just the amount of output that it's putting out as measured by GDP, these are important inputs when, say, analysts are looking at, say, stock market valuations. When you're thinking about, again, the value of an investment, you want to make sure there are cash flows underpinning that. Economic activity as a measure of what's going on in that broader economy, very, very important when you in that context.
Okay.
Right. So to answer your question more succinctly, Lou, we're viewing that as important because this is, again, just that measure of, is the economy firing on all cylinders as we recover from a very sharp downturn caused by the COVID-19 pandemic.
Okay. And I'll give a visual, which I promise no charts during these, but the V-shaped recovery, the sharp downturn really turned into a very rapid and sharp upward, we'll call it spike or mountaintop of the market, which brings me to the next question, the bubble environment. I've spoken with had other video conferences with other analysts, and we've talked about a bubble environment. So are we in a broad bubble environment, meaning, and by bubble, we mean the connotation that it can burst at some point soon? Or is it, in your opinion or Vanguard's opinion, just certain areas? And if I can ask you, Matt, to just hang on one moment, I do want to get to that in a while. And part of why I had to read a long disclosure for everyone today is that we are going to also talk about asset class specific. Matt's going to be good enough to share that with us. So the long disclosure, part of the reason for that is that we'll get to asset classes. So we'll start with the market bubble right now. Are we in one, or is it just certain areas? Please expand on that.
Absolutely. Absolutely. So when we're thinking about a bubble, Lou, I thought I'd start with just making very explicit Vanguard's definition of one. And so, you'd kind of alluded to this, but we're viewing a bubble, we're taking a very academic approach to how we're defining this. We're viewing it as an instance where prices far exceed an asset's fundamental value to the point that no plausible future income scenario can justify that value. So with that said, broadly, when we think about, broad market, we're not seeing necessarily that kind of dynamic playing out. We do have a couple of areas we're keeping an eye on, for sure, areas that we're deeming maybe a little frothy. So I'll expand on that a little bit. The first, of course, is housing. I think we've all seen plenty of press articles, plenty of comments made just about the behavior of the United States housing market, continued strong demand. The good news here is we're really viewing this as being driven by a couple of factors, and I'll really highlight two main ones. The first being pandemic era supply and demand dynamics. And what that means is just that general supply demand trade-off. If you listen to our global chief economist, Joe Davis, tell it, he'll lay out the fact that in some of these red hot housing markets you're seeing across the country, what in our view is driving that is the fact that there's elements like inventories being so low. So at a time when demand has stayed strong for housing with inventories low, again, it comes back to just general supply demand dynamics more so than, say, any sort of unexplained changes. And beyond that, the cost of financing, right? Again, no secret, interest rates are low at the moment. When it's so cheap to borrow money, there is the potential to justify maybe higher prices. So that's what we're thinking with the housing market. I'll quickly touch on, Lou, two other areas that we're keeping an eye on. And the first is within the stock market, growth stocks, and more specifically, what we're calling low quality growth stocks. And what we mean by that, these are names where there's maybe little to no operating profits. That is, they're unprofitable. And this is a group of stocks that in aggregate has outperformed the market over the last decade. And we accept that, a handful of them may become the next big thing, but similar to what we saw around the time of the dot-com bubble, many more may fade and ultimately not pan out. So this is an area that we're keeping a close eye on because the valuation, as in the price that we're seeing quoted among some of these names, I mean, some of them are at the point where the price is implying that their worth will exceed the size of their industry's entire contribution to GDP. So just a large, or really just a notable, perhaps, overvaluation in our view relative to what that fundamental value is for some of these names.
And that's in the tech stock. area specifically that you're speaking of?
Broadly, I'd have to look again and see if we named any specific sectors. That may not be just constrained to that.
Okay.
And then the last area that I'll name quickly is cryptocurrency. So this is an area that we are watching with some caution. Certainly, again, no secret about how these have fared over the last year. A lot of press attention given to these as well. And the question here, when I think back to that bubble definition, right, thinking about what that fundamental value is, that's really where the big question is in our mind. Defining that fundamental value of the asset, in our view, there's a lot of uncertainty around that.
All right. So the fundamental value of it, and this is something that I've debated with clients, with friends. I've spoken about cryptocurrency today twice with people that I know, and I'll say that the feeling and feeling is part of it. The feeling of I'll say something off, however you'd like to state it, and that was the feeling. But then we'll go with the business and logic part of it, saying that, well, is this a currency of the future? I've heard legitimate arguments on both sides of cryptocurrency. So with that in mind, and I know we have to stay compliant, but I'm asking directly on cryptocurrency. You're saying you're watching it closely at Vanguard as a part of the bubble environment that we may be in for that specific asset class. Is that correct?
Well, it's tough because I'm not even sure that we are calling it out specifically as an asset class at the moment. So there's a couple things to unpack there, Lou, if you'll indulge me.
Please.
We're viewing cryptocurrency as it's a really fascinating space because it's not certainly a traditional currency, though it shares some characteristics of one. It's not a traditional commodity, though in the way that it trades on cash cleared markets, or you can get exposure through derivatives. There's some characteristics of a commodity there. And again, asset class, is it not? So it's kind of this, it's an enigma in a way. And so when we're thinking about how you define the value of it, right? A lot of those traditional valuation metrics you might use become difficult, right? Does it generate future cash flows that you could discount? Not necessarily. And so our view really comes down to this idea that crypto prices depend on, I think as you alluded to, Lou, the conversations you're having, this speculation about their adoption and their use. I think another argument that we've heard is there may be the case there's a supply shortage that over time could sustain increasing prices. And in response, our economists would note that the supply of different cryptocurrencies has also increased over time. And there's not a reason that they see at the moment to think that supply couldn't keep up with demand.
Okay. Well, thereby lowering the value, the price of cryptocurrency. And I'm going to bring Chris in just a moment here to comment on that. Yeah, again, in the debates, and I love to talk about the feeling side of it. I love to talk about the logical side of it, the valuation side of it. It feels a little bit like trading pelts at the outposts when the Old West was, or even if we're the pilgrims, out on the internet is the more knowledgeable, if you will, Indian who knows how to grow corn or catch animals in America and sell us or trade something of value. Well, there's that part of it, but then you go again to the other side of it, and it's I think what makes it so fascinating, that rather than very simplistic thought process of it. Well, is it the future? Are we trading, if you will, government credits or something? So this is where I want to bring Chris in, because part of the general philosophy here at Tranquilli Financial Advisor is how do we, when the time comes, look to move assets away from the stock market or bubble environments if we're actually in them and looking to exit. So Chris, can I ask you to comment on crypto, if you don't mind, and also current environment at Beacon Capital Management with the stop loss in place? What level are we at? How far are we away from any kind of risk mitigation or stop loss in portfolios?
Sure. So thanks again, Lou, for having me. And on the crypto side of things, I'm like you. I have a conversation on this every single day with somebody. If it's not an advisor, it's a client, or if it's a friend, so on and so forth. Everybody asks about it. It's got everybody's attention. My view on it is right now it's too speculative for most of the investors that we work with to do it on a large scale. Now, obviously, we have clients, and even friends that it may be appropriate for a small part, of their investment portfolio potentially. But even the SEC just came out, I believe just yesterday, and labeled it as just essentially a big warning label. Please be careful. It's highly speculative, and it is relatively new. Still, I like to look at other things, in history, and how that works out. And one of them, it's just like social networks. Well, Facebook wasn't the first social network, so I'm not sure Bitcoin will ultimately be the winner when this is all said and done. And Matt mentioned it. It's all about supply and demand. We're seeing a demand for cryptocurrency and blockchain technology. So there'll probably be a lot of other players, and we already see them, out there. There are quite a few. In fact, even Dogecoin, it's kind of a made up thing, but it, comes in and it's getting lots of attention for no reason, really. Google, they weren't the first search engine. Yahoo dominated that market, and, Google effectively, made marginal improvements on it. But, they effectively took over that world. So we're still pretty early, in this particular space. As I mentioned, I'm probably more interested in the technology behind cryptocurrency, the whole blockchain technology, those types of companies, and what they're doing, whether it could be in healthcare, it could be in finance, across the spectrum. That's where I see that space, really growing, and could be, an opportunity for a lot of investors on a larger scale.
If you don't mind, Chris, I'm going to interject there.
Sure.
And explain blockchain as I understand it. So blockchain would the idea is it if you will, blockchain is the pipes that information is sent through, and blockchain consistently or continuously, if you will, reworks the pipes, meaning it makes it harder, nearly impossible, we'll say, for the folks on the internet to see what's going on within those pipes as anything, information, currency passes through. So that's the blockchain technology. It's a protection, effectively. And if I recall correctly, the Australian stock market is running on blockchain. If I believe I have that right, I think they were the test market that was running on it. So blockchain is, I agree, an interesting technology that could move the currency forward. But is it there yet? And that's a question for both of you. Is it there yet to jump with both feet, or how's this, even dip a toe into it rather than jump with both feet?
Yeah, when it comes to cryptocurrency, specifically not blockchain, I personally say no. I kind of put your money where your mouth is. I have no money invested in it at all, and I'm really not looking at it too seriously at the moment either. It's I tend to be middle of the road risk profile at best. So the idea of an investment that is really swinging wildly. You take one of the bigger names out there because of an SNL skit drops 49%. That, I don't know, that kind of spooks me a bit. So I tend to not go there.
I couldn't agree more. Matt, I'm going to bring you back in and we'll set cryptocurrency right where it is. We had great discussions on that over the course of the last year. And I will say thank you to everyone that's here watching it live, and also those watching after when we send out the recording. Get really great feedback on all of these, and become more and more comfortable in doing it. So thank you all for the feedback as well. Matt, are we starting to look outside U.S. borders? I think in the opening comments you mentioned that possibility. The U.S. stock market has performed very well by all indice marks. Are we starting to look elsewhere? You mentioned COVID in Europe. So if you would share where Vanguard is looking outside the USA, if you are looking outside.
Absolutely. Absolutely. No, this was actually the subject of a recent research piece we put out on our investor site for anyone to be able to access. In short, our view is that going forward, so over the next 10 years or so, we do view international equities as having the potential to outperform US, and I'll expand on kind of some of those specific figures towards the end when we talk about those asset class outlooks. And the most critical driver there being valuations. Right, so when we look at where US stocks are valued relative to international, I think that starting point in our view, pretty powerful determinant of what the following, the 10 years to follow is going to look like in terms of return environment. So broadly speaking, our outlook for global equities is still fairly guarded, I think, relative to the performance we've seen in the past, certainly over the past decade. But looking forward, we think about factors like valuation contraction of US stocks relative to international. That is, US stocks becoming slightly cheaper compared to where they are currently priced against international stocks, as well as the fact that we view dividend yields on international stocks being higher. So all of these factors combining for us to say that going forward, it is our view that international stocks will outperform.
All right, and from an allocation standpoint, are you comfortable commenting on an allocation from the standpoint of Vanguard's thought process of 10% outside U.S. borders in what you would call a moderate portfolio? Is that something that you can comment on for us?
Yeah, I'd say generally speaking, that doesn't change. Really, any sort of longer term asset class forecast like this is not going to change our kind of best practices or our investment philosophy as it pertains to portfolio construction. So we're going to continue to advocate for really what we've advocated for probably since we started talking, Lou and Chris, around just maintaining broadly diversified portfolios that include a global component to it.
Okay, and that is excellent, Matt, because that is part of the reason I work with Beacon Capital Management. Chris's portfolios using 11 different Vanguard exchange-traded funds in equal weight, exposing us to different areas of the U.S. economy and even the world economy. I see that as a good fit, if you will, at Tranquilli Financial Advisor. I'm going to move it forward here and ask you, and Chris, after Matt gives us some comments here, I would like your thoughts on lesser performers within the markets, value stocks. People, anyone that's listened to the news, you're hearing about value investments right now. If you would comment on value as a specific category.
Absolutely. Yeah, another area where we've got some really cool research coming out. In short, again, when we look at our outlook and those forecasts that I'll share, this is kind of the other big, let's say, reversal of what we've seen over the past decade that our forecasts are calling for over the decade to come. And that is, we do expect value stocks to outperform their growth counterparts. Two main reasons that I'll call out for that as part of our research. The first one is those macro fundamentals, right? The environment around the stock market. In our view, that explains about 2/3. So those factors alone explain about 2/3 of value's underperformance relative to growth. A big piece of that, as you'll note, again, in the research we have coming out on our website, is inflation specifically. So when you look at how that impacts what we consider to be fair value for value stocks, that's been a big feature. And going forward, we think about what our inflation outlook looks like. We think that'll be a little more supportive of value stocks. And then the other piece is, again, it's almost always going to come back to valuations with growth stocks. Recently, I think within the last 6 to 8 months, we've heard our investment strategy group say, only within that last 6 to 8 months have we hit a point where we really are expecting some sort of reversion to the mean in terms of growth stocks underperforming their value counterparts.
Okay. And it all reverts to the mean. I'm fond of saying that this time isn't different. This is just a different time. That's so, it's so, and if you keep that in mind, you'll know they'll in and out of favor. And Chris, that leads to you. If you would comment, where does value exist within the Beacon portfolios? Where you're holding that type of asset class or specific holdings within?
Yeah, absolutely. So as you mentioned before, we allocate across 11, sectors across the economy, equally. So we're not making a bet on any particular sector or part of the economy over another. So, whereas, the stock market, if you're looking at, the S&P 500, for example, it's making a bigger bet towards technology. It's the largest sector, running around 25%, of the market, whereas us, it gets same allocation as everything else. And, you're right. We're definitely seeing, and it's a welcome, observation that the market is broadening out. It was definitely very tech heavy, even before 2020 with the pandemic. But 2020 just exaggerated it even further, because those were the companies that could really continue to function as normal, during a shutdown. People were staying at home, and in fact, it helped them, in many ways. The whole stay-at-home stocks, is what everybody kept calling them. But now, as things are starting to reopen, those stocks are really starting to peel back. You're starting to see some correction area in that area. So that's, tech is probably the biggest growth, component of our portfolios. And many of them, like I said, are down 10 to 20%, in that range. So they are slowing down, they're peeling back, while the portfolio overall is doing fairly well. But we do have the value side of the equation. So financials and industrials, those are the two stalwarts in the value camp. They're both doing extremely well right now, pushing their way forward. As far as other things, consumer staples. So you're talking about, the Procter and Gamble's of the world, Clorox, things like that. They're still doing well. They're steady eddies. They're not doing badly at all. The other piece, that's doing well is materials. That's where, all of us are hearing about skyrocketing prices, on product, whether it's lumber or copper or anything along those lines. So that particular sector is doing well, and it's making up and helping out technology. So overall, you asked the question before and I didn't answer it actually. Where are we at on the 2.0 stop? That 11 sector portfolio is, as of last night's close, down 1.55%. So it's still pretty close to a new high. Market's down again today, so it'll be down a little bit if the market finishes where it is right now.
All right, good. So as of this moment, nowhere near any stop loss.
No.
And I will share with both of you that I spoke to an engineer today, mentioned to him that I wanted to have some work done here at the office. And he said, good luck getting the materials and a contractor. So I've got that to look forward to. But anyway, so we've got a couple of more topics. And Matthew, I'm going to ask you to comment on monetary policy rather than just stimulus. Stimulus has been front and center, newsworthy, sell, headlines sell kind of thing, 1.9 trillion, maybe another billion or so coming at us. What are we looking at from the standpoint of monetary policy? If you would give us a couple of minutes on that rather than just stimulus.
Sure. This is certainly a hot topic at the moment. In our view, when we're thinking about that liftoff in rates, especially as the inflation conversation continues to rage on, at the moment, we see monetary policy in the US staying pretty accommodative. That is, rates staying low, pretty much where they are until about 2023. So we do not see a Fed liftoff until around then. And this is, even with what we're expecting in terms of inflation, that is a cyclical bump. That is, so inflation peaking up a little bit, maybe a little bit higher than what we've seen over the last couple of years in the months and year or so to come. And this is because, for a couple of key reasons, but primarily that two things I'll highlight. One being that we think the Fed is going to be looking beyond just, say, that headline unemployment number when they're thinking about, hey, is it time to raise rates yet? We're thinking they're going to be looking at things like labor force participation. How many working age people are in the labor force, either employed or looking for a job? That's something that we saw tick down with the onset of the pandemic for reasons such as people having to leave the labor force to take care of their kids who are now at home, right? Or even early retirements. So factors like that. Plus, of course, worth noting that back in 2020, there was the shift in terms of policy where the Fed called out this idea that they would target an average inflation of around 2%. So rather than 2% at any one time, looking more of an average, perhaps leaving room for inflation to run a little bit hotter. And so in our view, that's what we're going to be seeing. I think we're going to see the Fed remain patient and accommodative for the time being. And broadly speaking, even internationally, similar kind of story with, say, the European Central Bank, remaining accommodative, using what they're calling the Pandemic Emergency Purchase Program to keep a lid on real yields.
Okay, so there's if you will, a process to inflation, which I've had this conversation previously during other video conferences that we've held, and I've said that as it applies to inflation, there are two words that I won't say right here, but I will say they start with B and S, because if you've paid a health insurance premium or purchased a car or went to the grocery store, you've seen inflation for years and years. Now, I understand it's not completely BS, but what I'm getting at is that we may see inflation in areas that we haven't witnessed over the course of the last decade, but inflation really has been a part of this market increase. That's my opinion. You're welcome to share yours about that specific comment, but my thought is that it's just different areas of inflation, and the one thing that hasn't inflated, again, in one financial advisor's opinion, is what people are paid. So there's been if you will, a natural inflation to everything because the data says paychecks have not gone up during that time.
Absolutely, and I think, and again, and also bear in mind too the different pieces of this recovery that we're seeing crop up that can also impact it. Because I know one hot topic of the day is those supply and demand imbalances, or even what you might call supply chain issues, right? Semiconductor shortage, a great example.
Lumber.
Yeah, as we emerge from the COVID-19 pandemic, we do view these as having the potential to push that inflation number up modestly in the short term. But again, we view this as being a transitory effect, that it's going to ease over time as economies are broadly able to get back firing on all cylinders with production of these types of goods. Mm-hmm. But to your earlier point, Lou, I mean, absolutely. And again, this is why it's a key point of our research when we think about what can explain the market behavior we've seen, even in terms of things like growth stocks outperforming to the extent that they have relative to value, right? We view inflation as being, again, a key input to that.
Okay. All right. So to wrap it up, we promised a conversation on asset class forecasts, and that gets back to our disclosure, which I will post again at the end of the video conference here in just a few minutes with the correct spelling of financial. Chris and I were laughing before this started that spell check wants to change advisor. It wants to change all kinds of things, and it got me on financial, which is kind of funny. So asset class, if you would give us some asset classes, a quick definition of those asset classes and Vanguard's forecast, if you don't mind, out to the end of 2021.
Sure. So we don't have 2021 forecasts. What we do, Lou, is again, we do average annualized over 10 years. That is what we expect over a 10-year period, every year that average return to look like. It's just the nature of our economic forecasting process. We tend to shy away from shorter term forecasts. So what I'll say, I'll start off with the one that we all know, US equities. Over the next 10 years, we're forecasting a 3 to 5% return. And these are forecasts made with our capital markets model as of year-end 2020. Beyond that, global equities, I mentioned earlier that our research showing they are poised to outperform. We're viewing that as about 6.1 to 8.1% average over the next 10 years. Moving to the fixed income side, again, all of these relatively muted returns compared to what we've seen in the last couple of years. US aggregate bonds, 0.8 to 1.8%. Treasuries are actually just slightly below that at 0.5 to 1.5. Corporate bonds, 1.2 to 2.2, so offering a little bit of a premium there. Looking at international bonds, 0.6 to 1.6%. So broadly speaking, I'll summarize all this by saying return outlook for equities relative to what we've seen the last couple of years, muted. Fixed income, muted as well. And what I want to emphasize with that is even despite fixed income not returning what you might have seen the last couple of years, again, that has not impacted Vanguard's thinking in terms of how you use fixed income or even should you use it, right? We maintain the view that this remains an excellent diversifier of equity risk when you think about how to diversify your portfolio.
Okay, and that's part of the conversation that fortunately I have with clients, I'll say frequently during reviews and just conversationally, these videos, in that while bonds don't hold an attractive outlook long-term, and you mentioned 2.2, which would be an attractive outlook, really. That may, and you can explain high yield, which used to be known as junk. Is that where the 2.2 comes from?
No, so that's investment grade U.S. credit. High yields, that range is slightly higher, 1.9 to 2.9%.
Okay, and Chris, I'm going to pull you in on this part of the conversation. Again, all of those asset classes, we have exposure for those working with Beacon Capital Management within your portfolios, bonds.
Yep.
US corporate.
We do run, diversified bond portfolios. And, this is probably an area where, Matt and I differ on opinions slightly. Where we agree is that, yes, bonds should be part of a portfolio pretty much at all times if you want to have a fully diversified portfolio. However, our bond allocations, as a rule or a recommendation right now, anyway, they are shrinking. We're making those allocations a little bit smaller. Most of the advisors we work with are making them a little bit smaller, just because there isn't the return projections Dan or Matt had mentioned, going forward. So rather than having, I don't want to say a dead asset sitting on the books, allocating a little bit more to the equity side, but we have the advantage because of how we manage our equity portfolio. We have that stop loss built in. And trust me, when we need it, we'll be piling heavy into the fixed income side, especially treasuries, which provide the biggest buffer or cushion, for the equity markets.
All right, that's excellent to I'll say finish right there, and I want to thank both of you for just over 45 minutes for this time. Matthew, thank you so much for organizing with Vanguard to have this conversation, which I believe is our second conversation now, and absolutely will ask you to be back here talking about more of this. We're going to take a little break from the long form video conferences. Everyone that's watching the video now, thank you again. I am going to bring up the disclosure in just a moment. Chris, appreciate your time as well and expertise. For those clients that are here with me now and listening, the invite and the follow-up to this with the video recording will include my calendar link. If you'd like to talk about any of these topics in more detail with me, I'm always glad to have a conversation. Please just use the Tranquilli Financial Advisor calendar schedule link, and I'll be glad to have that conversation. So thank you both again, and we will talk again soon.
Thanks, Lou.
All right, my
Thanks,
pleasure.
Lou.